Inflation is rising, but inflation hedges are going down. What on earth is going on? Hi, I'm David Wu, a former Wall Street investment strategist. Welcome to the Money Game Level 1, where I make predictions about how markets will respond to the big story shaping the world today so that you can make better investment decisions. This week's theme and focus is the performance of inflation hedges, assets that are supposed to protect you against inflation. You don't have to be an economist to know that inflation has been going through the roof lately. In fact, consider yourself lucky if you live in one of only a handful of countries where inflation is not a problem. In the US, however, consumer price inflation is at a 40-year high. Moreover, inflation expectations are at the highest level in more than a decade. Against this backdrop, many people are concerned about inflation eating into their real purchasing power. Many people want to find some ways to protect their income and savings. Yet despite surging inflation, inflation hedges have not been performing. For example, gold, long viewed as a reliable inflation hedge, has gone nowhere over the past year. Meanwhile, newfangled inflation hedges like Bitcoin have not done much better. A lot of money went into inflation-protected bonds last year, but these bonds did so badly over the past 2 months that anyone who bought them in 2021 have lost money. Why are inflation hedges doing so poorly just when you want them to work for you? I'm going to let you in on a little secret in case you don't know it already. Inflation hedges only tend to do well when central banks see inflation as a friend and rarely do well when central banks view inflation as a problem. This is because inflation hedges don't like rising interest rates. When central banks raise interest rates, inflation hedges like Bitcoin that pay no interest become less attractive. They become what Wall Street calls negative carry trades. For doubters out there, central banks increasingly view inflation as a problem, a big problem in fact. Just listen to what they were saying last week. The Bank of Canada governor said, and let me quote, "There is some uncertainty about how quickly inflation will come down because we've never experienced a pandemic like this before." In plain English, he was simply trying to tell us that there's so little visibility when it comes to inflation that he has little confidence in the projection by his staff of economists as to when inflation will peak and how long it will take for it to return to earth. Central banks are so worried that longer inflation stays high, the more difficult it will be to bring it back down. Last week, the Bank of England hiked interest rates by 25 basis points, raising interest rates back to back for the first time since 2004. Yet 4 out of 9 voting members were in favor of a 50 basis point hike, arguing that the strong increase in pay settlements, in recent wage negotiations, and the spreading of inflation from goods to services could make inflation more persistent. In America, even Biden's 3 nominees for governors of the Federal Reserve, all of whom are thought to be left-leaning doves, were talking tough on inflation at their Senate confirmation hearings last week. But most important of all is the fact that the European Central Bank joined the inflation chorus last week. Christine Lagarde, the president of the ECB, who insisted for the past few months that interest rates were not likely to rise this year, suddenly changed her tune. She now says that the decision on rates will be data dependent. It sounds like she's preparing the ground for raising interest rates. In my view, this latest shift in how the ECB views the risk of inflation is very important. Indeed, it's so important that it's certain to have global consequences. Let me tell you why. In 2014, the ECB decided to push interest rates into negative territory, and they have stayed there since. Currently, short-term interest rates in the Eurozone is at minus 0.5%. You might not think that minus 0.5% is a big deal, but let me tell you that there is an ocean of difference between 0 and minus 0.5%. For one thing, many central banks are not allowed by law to invest their foreign reserves in negative yielding currencies or securities. As a result of negative interest rates in the Eurozone, the share of euros in the total global holdings of foreign reserves of central banks have fallen from 23% in 2014 to 20% today. There is no doubt that the loss of appetite for the euro by reserve managers has been a major factor behind the weakness of the euro since 2014. Given the above, just a hint of an increased possibility that the ECB could bring interest rates back to positive territory was enough to send the euro 3% higher against the US dollar. I wonder if this was the reason why Putin asked to be paid in euros when he signed a 30-year natural gas contract with China last week. Another reason why what the ECB does with its interest rate is important is that it could spell the death of negative yielding bonds. Negative yielding bonds are a curse for bond investors, as you pay the issuers of the bonds for the privilege of owning the bonds as opposed to the other way around. So why do institutional investors buy these bonds? Because it's still less expensive than parking their cash in banks, believe it or not. Are there a lot of these bonds around, you may ask? You bet. At the start of 2021, there were $16 trillion of these bonds, nearly 15% of the global government bond market. Even now, there's still $7 trillion of these bonds, with most of them in Japan and in Germany. Because these bonds impoverish everyone who buys them, desperate European bond investors have been pouring money into non-European bond markets. Indeed, the net purchases of foreign debt instruments by Europeans over the past 12 months amounted to a whopping $900 billion. What effect did this have? It drove down bond yields everywhere. Even though it is impossible to prove, I strongly suspect that this has been a major factor alongside the Fed's quantitative easing program behind the unusually low real long-term bond yields in the US. In this respect, negative yielding bonds have helped fuel speculative bubbles, especially assets that generate no cash flows like cryptocurrencies or companies with no earnings. Did you know that the average return of companies listed on NASDAQ that have no earnings was 70% over the past 2 years, just shy of the return of companies that have earnings? Negative yielding bonds driving up negative yielding stocks, it sounds funny, but it really isn't. There will be a price to pay. It is just a question of time. Indeed, over the past 2 months, as rising bond yields have reduced the size of outstanding negative yielding bonds, the stock of companies that have no earnings have lost about a third of their value. If inflation in the Eurozone does not subside soon, this could be just the beginning. Over the past decade, many market commentators, including myself on occasion, have made the case for why Europe is converging to Japan. The argument is that Europe, like Japan, is aging rapidly, that Europe, like Japan, lacks vitality, that like Japan, Europe is heading towards deflation. The parting of ways of inflation in Europe and Japan over the past year has raised some serious questions about the validity of this thesis. Indeed, if anything, the fact that collective bargaining coverage is much higher in France and Germany than in Japan and the US suggests that there is a higher risk the higher inflation becomes entrenched in Europe via the wage negotiation process. Whether this turns out to be the case or not, only time will tell. But one thing is clear. We could be looking at a synchronized global interest rate hiking cycle for the first time in more than a decade. Millennials, many of whom have become day traders over the past 2 years, are simply too young to have experienced one of these cycles. Let me tell you that it makes investing a lot harder. So let's summarize. Inflation hedges have done poorly over the past 3 months, despite high inflation because central bankers are becoming inflation fighters. The European Central Bank joining the fight will have global consequences that won't be friendly for risky assets. Inflation hedges, especially those that pay no interest, remain vulnerable. Cryptocurrencies remain the most vulnerable in my view. Both fundamentally and technically, Bitcoin looks to me like a sell on rally story from here. If you find this video helpful, please subscribe to my YouTube channel. If you want to learn more and follow how I'm investing my money, come visit us at davidwunbound.com.